Now, as usual, I do like to start off the show with a summary of kind of what I saw happening in the market this week. What a week. Really incredible. First of all, this is the year-to-date chart for the S&P 500. Got that red line there kind of showing, the peaks trend is definitely down. Got the blue lines, the 200-day moving average and such too. So, our overall major trend is on a downward slide here. And we really had a poor September that just ended, on our last show. But this particular week had some very spectacular things happening. Number one, the first 2 days of the week, the S&P 500 went up 5.7%, which is violently up. I mean, that's really strong. It's actually the fastest start to a quarter since 1938. So really amazing. And one of the reasons you get that is because there is just a little bit of good news. Like at that time, we were talking about, England, was trying to raise their lower taxes on their upper bracket without funding it, and they were having some problems with their bond market, and they backed off of that. So that was good news. Market kind of responded to that, and then the job openings reports came out. It was at 11.2 million. It dropped down to 10.1 million, which again, we want lots of job openings, but there's so many openings versus the number of people that are unemployed. It's creating inflation, a wage inflation. So that when that comes down, that's a good sign. And what the market's looking for is a pivot by the Fed where they stop raising rates or even raise them less than expected or even change their rhetoric would be a good start. And so, boom, you start to get some motion. Once you get some motion upward, you have a lot of short covering that happens. Like that, the Monday, Tuesday, market was up around 3%. But the most shorted stocks that day were up 6.5%. So it just shows you big powers. These people, they short a stock. They basically, borrow it from a brokerage firm, essentially. They sell it in the open market. They hope it goes down. They could buy it back at a lower price. But if it starts to go up, they have an unlimited risk, so they buy it back. And, of course, as they're buying it back, that just means that it has a chance to even go up higher.
Snowballs it.
Yeah, right. And so that's kind of what happened Monday, Tuesday. But we're not holding that. And so, you'd like to see that go, right? And we got those 2 days, hold up a little bit, and then keep going, get through that blue line up there, that 200-day moving average. But Wednesday, we hit 0.2% down on the S&P 500. Yesterday, Thursday, 1% down the S&P 500. And we were nearing 3% down this day today, as the show started. So we're giving it back. We're still up a little bit for the week, but not a lot. And unfortunately, it's kind of another failure. If you look back there, you can see 4 green bars that went straight up, and then it failed then too. So this has been happening a lot. These are very common in bear markets where things are coming down. You get these sharp rallies because of the short covering. And then sometimes those sharp rallies short covering turns into, hey, everybody jumps on board, and you might turn it into, a new trend. But right now, the thing that's important to understand is that the primary trend is down. And so the secondary or the minor trend is up. Now, that's not normal. In 2021, in 2020, 2019, you name it, the primary trend was up all the way through all of those, and that's what's changed this year. And so that does take a bit of a different methodology here, in my opinion. We hung in there, did some rebalancing, tried to get the portfolios to work on the upside up until we got to that 20% down, and then we switched around the portfolio to be more T-bills, more ultra short-term bonds, and now even over the last 2 weeks, we've had an inverse position that goes up when the stock market goes down. And so our models right now are actually inverse. We are trading with the trend, which is down. And so I think there's some danger here for where we're at, because we're kind of getting back down to the low that we just hit in September. We could, fall farther, and there's not a lot of support underneath that, and we could come down fairly quick if we do come down. I think that's why the market's kind of selling off today. We do have one thing that's happening next week on Wednesday. We're going to get the CPI, the Inflation Report. Maybe that's good, right? Maybe there's good numbers. I wouldn't be surprised. Watch, it'll run up a little before. It's happened last time. Some hope that it's better. Turned out to be worse, actually, because core inflation went up last month, or the month before last. So we're going to find out what happened in September on Wednesday. That could be a catalyst. But the problem is the Federal Reserve is really, really committed to trying to go after inflation. And we're looking at probably a 3/4 point increase here on November 2nd when they meet. And then, there's some debate about what's going to happen in December when they meet for the last time for the year. Will they go with a quarter or a half or 3/4? Market's starting to factor in a 3/4 after today's report. So today, the big catalyst has been the jobs report. Mm-hmm. Okay, so this is the non-farm payrolls month over month for the last year. So here's a couple things I think I see out of this. First of all, we had 263,000 jobs created in September. But if you look at the overall trend over the year, it's coming down. Mm-hmm. The new job creation is softening. Got a couple of blips in there, in March and in July, et cetera. But we're heading downward, which now normally we don't want to see that. We want lots of jobs. We want to see it coming up. But this is an inflationary environment. And during a high inflationary environment, creating lots of new jobs creates a lot of wage pressure, right? Where you start to see an increase in wage. And wages are up 5% year over year this September versus last September. You can't have, in my opinion, 2% inflation when you have 5% wage growth, right? Mm-hmm. So they've got to get wage growth to soften up. And there are some good numbers in here, but it wasn't even close to being as good as people thought in terms, again, bad being good now, unfortunately. And so the market's now selling off because of that as far as that goes. And so, that's a key component to watch for here as far as that goes. And then, here's the unemployment rate actually dipped back down to 3.5%. Mm-hmm. I think that was probably the biggest surprise today. It was expected to stay at 3.7, which is where it was last month. And so here's why you've got to pay attention to the jobs reports if you want to kind of understand what the Federal Reserve might do. Because the Federal Reserve has a dual mandate, and they're pretty specific about this. Number one is to have what they call full employment, mm-hmm. right? Different definitions of that. Number two is to have low inflation, target being 2% on core inflation. And that sometimes conflicts with each other, right? They raise rates, and all of a sudden you've got a higher and higher unemployment scenario. But see, when you have unemployment coming down, mm-hmm. and when you still have 263,000 jobs that were just created for the month of September, the Federal Reserve can look at that and say, okay, that part of our mandate is good. We can go after inflation aggressively. And actually, if you think back to the history of how the Federal Reserve deals with things in the 70s, when we had this high inflationary situation, they raised rates and raised rates, and all of a sudden unemployment came up. And then they started to back down, probably from just, it's a painful scenario to have high unemployment for the country and those people that are unemployed. But it turned out to be a huge error because when they came back down, inflation wasn't completely stamped out. And we ended up with massive inflation at the end of the 70s and the very beginning of the 80s, to the point where the inflation, CPI was at 12%, not 9% like we just hit in July. And the Federal Reserve had to raise rates to 19%. Right, we're at 3.25% right now in order to bring that down. And of course, this is a real problem for the stock market because it's an environment where rates are extremely high. It's difficult for people and companies to borrow and to be efficient in that type of frame. And so that's one of the things that really drove this market down, starting with the Jackson Hole speech, was Chairman Powell's commentary about how they're looking at the 70s and they don't want to make that same mistake, and that they're going to stay on the inflationary pedal for longer than people probably expect, and they're going to continue to push down on inflation, I think, even if it means some higher unemployment, right? And so right now their projected unemployment at their peak inflation rate is 4.1%, maybe it's 4.4, one of those mm-hmm. two. That's probably wishful thinking, honestly, because most people seem to think it'll get closer to 5 or 6 by the time they really get inflation down. So, and this is what really I think is causing the problems for the stock market, is this long-term outlook of raising rates. And of course, usually when that happens, something eventually breaks. and that causes all kinds of problems. Maybe it's a emerging market defaults on their debt, or who knows what it is. Usually the worst ones are the ones that we don't know about right now, that we're not talking about. But generally speaking, when you raise rates and the globe raises rates like we're doing now, something breaks. I mean, that's been a normal scenario. We're all kind of looking around now, seeing what's going to happen. And that's kind of driving the market down. So, the other aspect of this is just kind of the recessionary pressure that comes on here. It looks like the gross domestic product projection is going to be decent for the quarter, actually, maybe 2.7%. We had the first quarter, second quarter were both poor, even negative, right? This one might be positive. So I don't know if we're in a recession already or not, but I think the bigger question is what's going to happen in 2023, because raise rates now affect 6 months from now. And they've been raising and raising and raising and raising. So, we haven't seen the full effect for what they've done already. And so that's why you see these indicators like this. This is by ClearBridge. I've talked about this before. And I'll move myself over here so you guys can see the sources and everything here too. But this is a really cool measurement of recession risk here. It's 12 different pieces. They kind of have a green or yellow or red, depending on where it's at. But the overall signal right now as of August, has gone to recession, right? And it wasn't even in June. It was still green. So things are moving in that direction on a leading indicator basis. And then we go and we look at, the next one here, the leading economic index. So that's a blue line, right? The gray line is actually what they call a coincidence index. It just means that it's the actual economy right now. And so if you look at that blue line, here in the recent times, you can see it's peaked quite heavily, actually. It's really coming down, whereas the gray line there is still going up. So the economy, just like I said, the GDP is still growing, but the indicators that look forward are down. And if you look back, to the 2006 timeframe there, you see a peak. Eventually led to the giant, recession that we had in 2008. Stock market dropped 57% there. You look back even farther, there's another gray bar there. That was the 2000 recession. Market dropped 45% there. So, this is one of the things you got to be concerned with. Yes, the market has come down 24% from the high, but in the last two times that this thing peaked, it was down 45 and 57%. So that's somewhat concerning, as far as that goes. And then the last one is just the yield curve inversion. This is the 10-year Treasury versus the 2-year Treasury. And what this shows is just the difference. So when it gets below zero, that means the 2-year Treasury is paying more than the 10-year. And you can see, again, first bar out there on the left shows the 2000, it inverted. Yeah. And then the next one, it inverted again before 2008. You can actually go all the way back to 1960 and see that this is fairly accurate. And if you look at where it is right now, just over Easton's head, it's inverted. And so, actually David Rosenthal on CNBC today said that there's never been a bear market that has bottomed out when the yield curve is inverted and the Federal Reserve is still raising interest rates. And so there's been a lot of talk that we already hit our bottom here in September, right? That low. Well, it would be the first time in history that had happened. And there's unfortunately more likelihood that it continues down. And again, this just to reiterate, because I got some questions this week, why are you going inverse, after we had those two huge days up, and so, but this is why, right? So I'm trying to talk about, if you look at kind of the overall economic indicators, if you look at the technical indicators inside the market, it's definitely pointing towards some lower markets. If you look at the overall major trends still being down, you want to trade with that trend for a while until we can start to see some better proof for when, things might bottom out as far as that goes. So you can still make money here. You can still preserve capital here. There'll still be a great opportunity to get in at some point if it does go down farther. They kind of tamed inflation finally in 1981, and the 10 months in 1982, the S&P 500 went up 106%. So there's some chances here to make some money. And we just have to be a little bit patient here and maybe a little bit careful not to lose so much while we're waiting. So that's kind of what we're waiting for right now.
So what's the lag period between the Fed and, taming? Are we looking at taming inflation? Are we looking at like a 6 months lag period? Because it seems all these reports are coming out are kind of confirming things rather than, giving us kind of a informed picture of what's going to be ahead.
Well, yeah, the leading economic indicators are useful to look at because they go both ways. So when they peak out, that's usually a sign that things are going to fall. But then they also go up. If I go backwards here, they start up oftentimes, fairly early, and they're a good signal that things are starting to improve. So that's one of the things you'd be looking for as far as a bottoming process within the stock market. But there's a whole bunch, as to what we want to look for there. But right now the indicators are actually, like I just showed, the jobs are kind of coming down. The new jobs are coming down, but they're still above average. 263,000 jobs is still above average for what we were getting before the pandemic. We still have 1.7 people looking for jobs as unemployed people versus the number of jobs open. So, 1.7 jobs open for every one person looking. That's a very tight job market, and so that's got to soften out as far as that goes. But the market does look forward. So it's looking forward 6 to 18 months, and so it's going to be looking for a chance to move forward. And normally it'll happen when everything's really bad. Like the bottom in 2008 with March 9th, 2009, I remember that, there was no good news. And you really had to pay attention to the price of the market more than the news because the data was terrible. But the market works in advance, and it is one of the leading indicators. Matter of fact, it's in the LEI basket. This basket right here includes the S&P 500. So, watch the price and watch for that bottoming motion and those type of things. So anyway, that's what's going on in the market right now. Really appreciate, everybody getting a chance to hear the summary. Hopefully this answers some of the questions. Don't be nervous about what's happening, at least with our clients. We're taking care of this as well as we can, definitely watching it. And again, this is a chance for opportunity if we do this correctly. So keep that in mind. I think a positive outlook here will be better than a negative outlook in terms of trying to make some money out of this. All right, so that's our summary for today. I want to thank everybody, and again, look forward to talking about this again next week.